Okay, we want to welcome everybody to our webinar today. We appreciate you being on. We expect a few more people will be joining very shortly, but we thought we would go ahead and get started. I'm Kelvin Cullimore with BioUtah. We appreciate having all of you participate with this particular webinar that's being hosted by Tanner and Company. We are thrilled to have Tanner as a member of BioUtah. We have had a great relationship with them. They've been very supportive of the biotech industry. And today we're going to hear from two of their experts, Matt Newton-Schwander, who is the tax manager with Tanner. He's had over 7 years of experience in public accounting, started with EY or Ernst & Young, providing tax services to technology, pharmaceutical, and biotech companies, and as well as aerospace and real estate companies. He did some work on R&D and orphan drug tax credits, showing that he is definitely familiar with our particular industry and the things that we're working with. Done a lot with PPP forgiveness applications. So if any of you are working on that, he's certainly a source for helping with that particular morass of bureaucracy. Matt received his bachelor's and master's in accounting at BYU, licensed CPA in the state of Utah, and a member of the AICPA, as well as the Utah Association of Certified Public Accountants. And we also have with us today Sean Marchant. Sean is the tax principal with Tanner. He has been in for 23 years advising clients regarding federal and state tax credits and incentives. His experience is quite vast. He spent 16 years with the Big Four, most recently with Ernst & Young in the Southeast region, and began his career at Deloitte's National R&D Tax Credit Group, and spent 2 years in its Accounting Methods and Periods National Practice Group in Washington, D.C. He's a frequent speaker on credits and incentives. In addition to being a CPA, he is a licensed attorney in the state of California. Received his JD from BYU's J. Reuben Clark Law School, and also got an LLM from Georgetown University Law School. So Sean has got a phenomenal background. We're fortunate to have him here and available to help with our companies. And we have been talking to Tanner about today's topic of monetizing tax credits, because we felt many of our companies may not be aware of these specific opportunities. Many of our companies are pre-revenue, and they generate a lot of R&D tax credits and feel like those tax credits may not be of much use until they are profitable. But our guest speakers today are going to tell us differently and how those can be used. And then some special tax credits associated with COVID-19 legislation that we all need to be aware of as well. So with that introduction, I'm going to go on mute, and I will turn the time over to Matt and Sean.
Kelvin, thank you for that introduction. We are delighted to be here today, and we will, as we go through these slides, we will make them available to you later. Part of my time, so I know Matt has a lot of experience in the life science industry. When I was with the Ernst & Young in the Bay Area, that was probably 80% of the clients I served in that area of the country. So lots of experience with, and then I've served some international life science companies as well with their US R&D credits. So very familiar with the industry. Love working with the life science companies because of the real difference they can make in people's lives from a health and well-being and longevity standpoint. Here's a disclosure, standard language here. I don't think we need to go over that. Matt, let's go to the next slide. A little bit about Tanner real quick. We are, we're not the largest, we're the second largest CPA firm in the state in terms of headcount, 175 employees, 19 partners, more than half of whom have been with the Big Four, have Big Four experience. So great, great firm. We provide all kinds of services not just assurance and tax compliance. We can do international tax. We can do transfer pricing, state and local consulting and compliance. We can also get involved with leadership solutions, information security. So if you have applications or devices that are connected, we have an IT and InfoSec compliance group that can help out with that. So really, and as terms of CPA firms, we are the only one that has in Utah that has all of those specialties. So really some great experts here at Tanner. Matt, let's go to the next one. All right, so quickly dive into the agenda. I thought we'd level set here with what refundable versus non-refundable credits are. And we'll dive into each of these ones individually. The R&D credit, most people I think should be familiar with that, but there's some there's a twist on that for small startups and pre-profit companies that they can monetize that with the payroll credit. There's also the orphan drug credit that is available, and then the employee retention credit, which is the most recent credit to come into the law. And Matt will spend a bit of time on that. So without that, Matt, why don't you walk us through just level setting? What's the difference between a refundable and a non-refundable tax credit?
Sure. So refundable is it's stated there, generally provides a cash refund. And so if you can basically monetize those credits immediately or in the near future without having taxable income. And so the example that Sean mentioned there would be the payroll tax credit for qualifying startup and pre-profit companies. And so generally that's going to be the first 5 years of 5 tax periods that a company has, where if they have R&D credits, they're going to be able to use those credits based on an election to offset their payroll taxes. And so, if company has, employees that it pays and has that payroll tax liability, it can use those R&D credits to offset that payroll liability. Another example of a refundable credit would be something like the employee retention credit. And so that was one that came about as part of the CARES Act last year, and then has been expanded and extended into 2021. We'll get into some of those details, but that's another example where the credit is refundable regardless of the income tax position that the company is in. And then the other type would be non-refundable, which generally means it's only available to offset current income tax liability or to be carried forward into a future when there is sufficient tax liability. And sometimes there's an expiration period associated with that. Some part of the Utah credit is an example of a state credit that doesn't carry forward, and so it's kind of a use it or lose it credit. So those non-refundable credits, generally, you're going to carry that forward as a tax asset to offset future income tax liability. And so that's not something that'll necessarily send you a check or put money in your pocket. It can only be used to offset taxes that you have currently or in the future. And so 2 examples of that would be the research credit or the R&D tax credit or the orphan drug credit. Both the credits can only be used to offset current tax liability rather than to provide a refund in excess of that liability.
Matt, what happens if I have a company that has R&D credits sitting on my balance sheet, can't use them, and I sell my company to someone else? What happens to those credits?
Yeah, so some of those credits, if there's a transaction where the company is acquired and there's a gain associated with that, that would be one example where they might be able to be used. And to the extent that they're not used or the company is purchased, they would carry over to the purchasing company, assuming it's a stock deal. There might be some limitation in terms of how much credits that acquirer can utilize on any given period, but generally those credits will carry forward to the acquirer. And so if they're not used when you sell the business, it's something that may provide value to or increase the purchase price of a company if there's available credits that a company can utilize with the purchase of an entity.
Thanks. So let's talk about the research credit. This is the granddaddy of all tax credits. It has been around since 1981. It was part of Reagan coming into office. With that Congress, they enacted tax reform. And it was really, at the time, an incentive to keep high-paying R&D jobs here in the US. The trade war at that time was with Japan, and there was a companion credit called the investment tax credit. So the R&D credit was really meant to incentivize jobs here in the US. The investment tax credit, which expired in the early 90s, was really for the capital equipment. You purchase capital equipment, you can claim a investment tax credit for that. R&D credit has stayed around for years. It was this, it would expire every 2 years, and now they've made it permanent. And there's always been a broad support between both houses of Congress and whoever was in the White House to continue to support the R&D credit. So that's a good thing. It is a credit against tax, so dollar for dollar reduction against whatever tax you owe. There is a somewhat complicated formula in how you calculate the credit. It is an excess. It's a percentage of the excess over some minimum floor or minimum base, which is derived by formula. And the shortcut way to think about the value to you is 7 to 10 cents on the dollar, maybe 7 to 11 cents on the dollar is what the credit is equal based on the eligible expenses. Most states follow the federal credit. Utah has a particularly lucrative R&D credit. If you're paying tax, if you're not paying tax, it's run of the mill, but it does offer a credit. And I think somewhere around 40 other states offer some R&D credit, the rules of which generally piggyback off the federal. For the R&D credit is an activity, because it's a jobs credit, it's an activity-based analysis. We look really at what you're doing, not what your job title is. So you could be in marketing or you could be in customer service. And so long as you're doing some of the roles that are defined as being credit eligible, we can pick up some wages associated with that time. It is a fairly contentious item with the IRS. They have never liked it. They continue to dislike it. They feel like it's an area for abuse. And so it really requires taxpayers to have documentation in place to support that. Now, the great thing about the life science community is you can bury people, bury the IRS with the kind of documents they look for. So that's a great thing. The thing that most accounting or most life science firms don't have, however, is some connection between what the people are doing and the products they're working on. Think of it as a time tracking system. And while that's not specifically mandated by the code or the regulations, that's effectively what the IRS likes to see and how they audit. And so frequently companies hire us or somebody else to come in and help them quantify the amount of time that people spend on R&D, and that becomes part of the documentation package. A great thing about this credit, and all credits for that matter, is you can claim them for all open years. There are some exceptions to that, but generally if you've been in losses for 3 years or 5 years or 10 years, you can claim R&D credits all the way back, depending on your particular organizational structure, your legal entity structure. You may not need even to amend returns. You can probably just adjust it on a carry forward schedule in your current year and you're running away. So this makes the R&D credit particularly valuable for companies. Matt, let's go to the next one. And we'll probably start moving through some of these a little more quickly, but if you have questions, feel free to raise your hand or chime in and we'll answer them. So how do I qualify for an R&D credit? Well, there's really 4 tests you need to meet, and they're conjunctive. So each one of these need to be met. The first one is you're developing something new. It can be, it's called a business component in the code, but it's really a product, process, technique, or invention. And it's really related to function, performance, reliability, or quality. Issues you run into, style, taste, cosmetic, or seasonal design factors, generally don't come into play in the life science community, but those, if they did, they would not be an eligible activity. The second requirement is you have to be used in the hard sciences. So biology, chemistry, physics, engineering, computer science, all that works. Key thing is if you're doing a medical device that's software driven and you're writing software to do the analysis or to control that device, the software activity could qualify as well, not just the development of the hardware in which it's going to be incorporated. The third and fourth tests are the ones where the IRS spends the most time. The third one is uncertainty. There's at the beginning of the project, you've got to be uncertain as to one of three things. Can you build it? How are you going to build it? Or what is the right design to achieve our objective? And then that naturally and logically leads into number four. I've got these unknowns I have to solve. So I'm going to go through some systematic process of experimentation where I'll test and evaluate. I'll test one alternative, evaluate it, look at the results, make changes to my design, retest it, reanalyze it, make additional changes. So you go iteratively going through that. The great thing about life science companies is they generally follow the scientific method. And that's kind of what this is based on. So if you're doing that, you're generally going to qualify. And most life science companies will qualify for the credit. In fact, I'm not aware of any that really have not. But there are some gradations within this where you may or may not be able to pick up certain people. A lot of times what I'll see, and Matt, you can go to the next slide. Sometimes what I'll see is they'll claim certain people, but not others. And that's really, sometimes the low-hanging fruit is easy to identify, but the other areas become a little more difficult. And we'll talk a little bit about that. So what doesn't qualify for the R&D credit? Well, once you've built a product and you've released it, now any manufacturing related activity wouldn't qualify, as well as scale up for production. The great thing with the life science community is the IRS issued some guidance a number of years ago that said, as long as you're in preclinical and clinical trials, all of that work will qualify for the R&D. It's only until you receive the authorization for marketability that they say R&D stops. In general, now there's always some examples or some cases where you can get around that as you try to improve the product. You maybe extend its usability or its use case to other factors or other conditions that would, even though it's research after commercial production, you're trying to use it at a different, for a different indication. Adapting existing business components. This is really exclusivity. A customer would come to you and say, we want you to build this product for us exclusively, and you cannot market it to anybody else or use the technology or what you learn in your own business. So that wouldn't qualify. Just duplicating something that's already out there, where you look at the blueprints or plans or formulas of something that's currently available. This is where a lot of generics fall up, is they're just taking the product that's already out there that's off patent and duplicating it. Surveys and studies that are related to management functions or techniques don't qualify either. Routine data collection, marketing studies. So a lot of times you'll be doing a marketing study as part of the research. That marketing study would not be eligible either. Internal use software, generally I don't see a lot of that in the life science industry. This is where you're writing software for your own internal purposes, such as accounting or finance or payroll or inventory management, marketing software, website development, that kind of thing falls under internal use software. Social sciences, arts and humanities doesn't qualify. Foreign research, this one trips up or can trip up a fair number of life science companies. Because it's a US jobs credit, they require that the work be performed in the US. Now, I had one client that was doing, it was headquartered in the UK. They were doing R&D in the US, and the IP was owned by Japan. They got what we call the triple play, or the hat trick if you're a hockey fan. They got a credit or a super deduction in each of those locations because each jurisdiction had different rules. The UK said, the US says the work has to be done here. Okay, that's fine. The work was being done here. The UK at the time said you have to have management and control in the UK. Okay, great. It was always all being managed and controlled out of the UK. And then Japan said, for you to get a Japanese R&D credit, the IP needs to be owned in Japan. Perfect, done. So this was a rare instance where they tripled the benefit for the exact same expenses, in addition to any state credit they would have gotten. But the point here is the foreign research. There are a couple points. One, for the U.S. research, it has to be here, but there are many other countries that offer similar credits or super deductions for R&D performed in those countries. The last one is funded research. So I know with life science, there's a lot of subcontracting or licensing arrangements. Maybe big pharma comes in and says, we'll fund you, we'll take a license for future sales, but we'll pay you some amount up front to help get you there. Those contracts, if not written correctly, can cause one or both parties to not be eligible for the related R&D expenses. So whenever there's a contract situation, whether you're receiving money from someone else or you're paying someone else to do research on your behalf, careful analysis needs to be made of those contractual terms around rights, who owns the IP that is being developed, and then who's at risk for the development. A quick and easy way to determine that is fixed price contracts are generally, the risk is borne by the person performing the research. If it's a time and materials contract, then it's generally borne by the person who's paying for the research. Let's take a look at the other one, Matt. What else have we got out there? Next slide is, all right, so that's the activities. Let's say you're all eligible and we've identified things that are not eligible. What expenses can I actually include for a credit? We are limited to 4. They are wages, they are supplies that are used or consumed in building and testing the prototypes. There's computer rental, and then there's contract research. Let's talk about each of those in turn. Wages are just what they mean, what I'm paying to employees for doing research. Now, there are 3 groups of eligible employees. There's the individuals who are performing the research. We call that direct research or qualified research. There are those who are supervising the researchers. So they may be in a management capacity or a lab supervisor capacity. And then there is the support function. So support would be someone who might be in regulatory, or they could be in marketing, or they could be in product management. And they are sitting in the product development meetings, and they're talking through new functions or features. They're reviewing clinical trials. They're helping to coordinate the clinical trials. They're providing input from government regulators as to the specifications or requirements that you need to meet, all of which the developers or the scientists will take and incorporate that into their testing, into the test plans, into the clinical trials. So you can include that in some extents for smaller companies where you've got a science, either a scientist or a doctor founder. They are integrally involved with the development. And so we can pick up those people as well. So, here's a list of some qualifying departments, the ones that we generally see. There can be others depending on their facts, but the low-hanging fruit are research and R&D and engineering and QA. The ones that I've been to some companies here in Research Park up here in Salt Lake City on the bench, where they were being advised by somebody else. They were only picking up the R&D people. They were missing the CFO or the CEO who was a medical doctor, and it was his baby. They weren't picking up regulatory, and they weren't picking up anybody from the manufacturing side. So while they were getting a decent credit, their credit could have increased by 30% more simply by including those other groups. Let's look at the next one, Matt. So supplies and computer rental. Supplies are the tangible products or tangible goods or items that go into building the prototype or the drug. It's going to be the raw materials. It's going to be the whatever that might be, liquid or powder or solids. And it would also include anything that could be a reagent that you're using to test. So it would include those chemical supplies. It does not include, however, test equipment. So if you buy a fancy electron microscope or a centrifuge, an expensive centrifuge, that type of equipment, even though used exclusively for R&D, is not eligible for the credit. It's limited to non-depreciable property. The other one is computer rental. So really, I see this a lot more in for my software clients, where they are renting space from Amazon Web Services or Microsoft Azure, and they're developing software on someone else's computer. That's really what that computer rental is. The third one, the last one actually, is contract research, and these are payments you pay to a third party to do research or testing on your behalf. It includes both CROs, contract research organizations, as well as CMOs that would do research. You do need to look at the contracts and how those play out. You're limited to 65% of amounts paid to people who are performing those services for you. Again, the contractors also need to be based in the US. And so if you have a clinical, let's say you're doing a clinical trial, and some of it's in the US, some of it's in Canada, some of it's maybe in the EU, you would need to look at those expenses. And let's say it's a lump sum amount that you're paying. You would need to look at those expenses and bifurcate them by location. It'd be great if the CRO would specifically line item you those expenses, but if they don't, that's highly unusual. What you can do is just generally add up and take a pro rata amount. That's what we've seen. Again, this is an area that is fraught with landmines, so you need to take a look at the contracts when seeking to include contract research expenses. All right, so I think that is it from the R&D credit. I will say documentation is key. It is the single most prevalent reason companies lose R&D credits is they have not sufficiently documented the R&D activity that is occurring. Again, the good news is for life science companies, because of FDA regulations, that tends to be less of an issue. It's more of an issue, however, of quantifying people's time and determining that on some level. It doesn't have to be weekly. It doesn't even have to be monthly. It could be semi-annually. It could be even annually. But it is documentation you would need to put together. Let's talk about R&D credits or payroll credit. Let's say you've got an R&D credit, but you're a startup company, or you haven't made any money, you haven't had any sales yet, you're living on investor money. R&D credit does you no good. And for 25 years, that was a problem. It wasn't until 2015 that Congress, actually 35 years, Congress came out and said, we recognize the R&D credit doesn't help some of the companies who really are doing the innovation for us. And so we will amend the R&D credit language and allow them to take that R&D credit against payroll taxes. So it's still, in essence, an R&D credit. The only difference is you are now applying it against your payroll taxes, which if you're not selling any product, you've got employees, you'll have payroll taxes, but you won't have any income to offset it. So it's a great benefit for qualifying companies. It will offset the Social Security component. So you are limited to the employer's portion of that, 6.2, but it is the biggest component. How do you qualify for the payroll credit? Well, first, you have to be eligible for the R&D credit, and you have to report the R&D credit on your federal income tax return. Second requirement is, in the year you're trying to claim the credit, you have to have less than 5 million of gross receipts. Now, gross receipts is not as limiting as you think it is, and we'll talk about that on the next slide. Then the third requirement is that there is this window period of 5 years in which you're allowed to have gross receipts. Once you get back further than that 5th year, you are no longer eligible. So let's talk through numbers. If for 2020, you could have gross receipts in 2020, 2019, 2018, 2017, and 2016. If you had any gross receipts before 2016, you would no longer qualify for the payroll credit. Still good for the R&D credit, can't claim the payroll credit. Other thing to note here, and I've seen some clients get tripped up on this, is if you started out as an S corporation or a partnership, and then you converted to a C corp, you've now terminated your tax year. You have to file a short year return for that. If you did it mid-year, you'd have to file 2 short year returns, one for when you were an S corp and one for when you were a C corp. That creates 2 tax years. So if you did that in 2017 and you're trying to claim the R&D credit for 2020, you would be okay, but you would not be okay for 2021 because you've now got those extra years. Let's go to that next one, Matt. So what are gross receipts? Gross receipts are pretty expansive. It's not just sales of product. It includes sales from receipts from services or license revenue. It includes dividends, royalties, rents, and this is the one that can kill you. Interest. You get $1 million of investor money, and you take and you put it in the bank in an interest-bearing account at 0.505% or 0.5%, and you get $5,000 of interest during the year. You have busted yourself from you start counting that from that year on. So if that happened in 2015, you cannot claim a payroll credit in 2020. I think it's a miscarriage from the IRS. It was their interpretation of the rule. There's not a de minimis rule that says below some threshold, we're going to ignore that. I think that ignores the business reality of small companies, startups, but that's the rules we have to abide by. The other restriction here is this payroll credit. It's an election, so you have to make it on your originally filed federal income tax return. Can't go on an amended return. So if you are coming to me now and say, Sean, this is great, I'd love to do the payroll credit, can I go back and claim it in 2019? Nope, can't do it. It's only the current year return. So you need to be mindful of that. You can claim up to $250,000 of credit, and that's per year for 5 years. So it's really worth, over the life of 5 years, $1.25 million. What happens if you don't have enough payroll credit? Hey, it carries over. So the mechanics of it is you file your tax return. The next 941 that you file, you report this on that, and depending on your payroll company, they should start applying it against payroll taxes immediately. I see variances in practice with payroll companies, so you need to coordinate with them. But the point is, any balance will carry over until it's fully exhausted, even if you fail to qualify for a payroll credit in the future. The ones that get elected and reported, they can be carried over until you run out of them. So no questions. Oh, let's see. I don't see any questions right now. So Matt, you want to talk us through orphan drug credit?
Sure. So orphan drug credit, it is a federal income tax credit that's equal to 25% of your clinical testing expenses. And so it's kind of focused on orphan drugs or pharmaceutical treatments, therapeutics that treat conditions which are fairly rare. And so, without some type of incentive, companies may not produce treatment for those type of diseases. Generally, it's targeted to conditions that have 200 or less thousand cases, 200,000 or less cases in the United States. And so, like I mentioned, the benefit is around 25% of the clinical testing expenses. It used to be 50%, but that changed in prior to 2018. You do need to receive an orphan drug designation by the US FDA. And so any expenses incurred prior to that designation or prior to receiving that orphan drug letter would not be qualified for the orphan drug credit. you'd still be able to use those expenses for the regular research credit that Sean had talked about. And so that eligible period begins when you have that orphan drug designation, and it's going to end when that drug or treatment is approved for marketing. Like I mentioned, it's only for clinical testing expenses, and it is limited to wages, supplies, and contract research that's incurred during that US-based clinical testing. There is an exception if there aren't enough people in the United States to treat or test. So they'll allow you to go outside the United States to do some of that clinical testing and still count those expenses. And so it would exclude any non-clinical or preclinical expenses related to that product development. And so those, again, would go toward the R&D credit, but they would not be included as part of that orphan drug credit calculation. Contract clinical research expenses can be included at 100%. And so that was one where Sean said you have to take a haircut or a reduction if you're paying a third party to do the contract research. For the orphan drug credit, you can include all of it. You don't have to take that 35% or the 35% haircut or include just 65% of the expenses. One important point is that you can't double dip. And so the wages that you count toward the orphan drug credit can't also be used toward the orphan drug credit. So if you had a scientist who spent 30% of his time on orphan drug, you'd allocate that percentage of the salary toward that development because it's going to give you a better benefit. It's going to give you 25 cents on the dollar versus the 7 to 12 or up to 15% that research credit will give you. So orphan drug is a little bit more lucrative, but it is just limited to that clinical testing expenses for the appropriate designation. And with that, I guess we're ready to move on to the employee retention credit. And so that was a new one that came out as part of the CARES Act last year that encouraged businesses to retain employees during government-ordered shutdowns. When it originally came out, it excluded PPP loan recipients from claiming. And so you could either do the PPP loan or you could claim the retention credit. That changed in December with one of the more recent stimulus bills. However, you can't double dip. And so certain wages paid to employees can't count toward the PPP loan forgiveness and the retention credit and the R&D credit. And so there is some type of an allocation that you need to look at in order to determine, what wages would count toward which of those programs. Again, kind of looking at, which one provides the most bang for the buck, allocate as much as you can to there, and then the next one, and then the next one. And so there might be some ordering you're going to want to consider if you're qualified for all of those programs. Qualified wages are limited to $10,000 per employee for all of 2020. And so you would look at wages paid to an employee for an eligible corporation, and then the credit would be 50% of that amount, up to $10,000 in wages or $5,000 in credits. The employee retention credit was extended, and so it goes through 2021. However, the benefit in 2021, if you're an eligible employer, is a little bit higher. You can qualify up to $10,000 a quarter in wages, and the credit percentage is 70%. So it could be up to $7,000 per quarter per employee in 2021. The type of wages that qualify can vary based on whether you're a large or a small employer. Generally for 2020, a large employer is more than 100 employees, full-time employees. For 2021, it's more than 500 full-time employees. And so that changes. And so you may be a large employer in 2020 if you had let's say 150 employees, but then in 2021, you'd be considered a small employer. And we'll get into a little bit on, which wages qualify for all of those. And then that credit is either claimed on an original or amended payroll tax return. And so if you didn't claim it in 2020 because you weren't aware that you qualified, you can go back and claim that, and it is a refundable credit, as I mentioned earlier, although the IRS is taking their sweet time in issuing those refunds due to so many companies applying for it. So some of the other recent changes, there were two other programs. One is for recovery startup businesses. So generally, to qualify for the retention credit, you either needed to have a significant reduction in gross receipts or have your business partially or fully shut down due to government order. So you'd meet one of those two criteria. For certain businesses that are just starting up, and so that started after February of 2020, and have annual gross receipts of less than $1 million, they can claim up to $50,000 in credits for Q3 and Q4 of 2021. They don't have to show a reduction in gross receipts because they may not have had much gross receipts to compare it to. And so that's an option that's newer for recovery startup businesses. And then for certain employers that had are considered severely financially distressed, and so that means they had a reduction of 90% or more than 90% of gross receipts compared to that same quarter of 2019. They can basically treat any wages paid during that qualification period as eligible for the retention credit. And so getting back into, what is an eligible employer? You're going to look at pretty much any employer, including tax exempt organizations that operate a trade or business in 2020 or 2021. And to be qualified, you're going to have to meet one of these two tests. And so it's either, looking at a specific period or quarter in which the employer had a significant decline in gross receipts compared to the same quarter of 2019. And so as an example, you could look at Q2 of 2020 and compare it to Q2 of 2019. And did you have a significant decline in gross receipts from the current quarter to that one that you're comparing it to? In 2020, to become an eligible employer, you needed to have a decline of at least 50% or more in 2020 to be considered eligible. For 2021, that requirement was reduced to only 20%. And so if you had a 20% decline in gross receipts in Q1 of 2021 compared to Q1 of 2019, you'd be eligible for Q1 to claim this employee retention credit. The other option is that you had the operations of your trade or business either fully or partially suspended due to a government order that limited your ability to, perform commerce, travel, attend group meetings due to COVID-19. And we will get into a little bit more detail on that one. But first, with the reduction in gross receipts, and I covered a lot of this already as I was kind of introducing it, but again, you're comparing a certain quarter to the same quarter of 2019. So post-COVID, pre-COVID. And, what are the gross receipts? You're going to, and so you become an eligible employer for the retention credit. So it starts in that calendar quarter that the gross receipts have been reduced. And then it ends at the end of the quarter that you no longer have that reduction, that significant reduction in gross receipts. And so in this example, we've got Q3 of 20 compared to Q3 of 19. Looks like if there was greater than a 50% decline, you would become an eligible employer in Q3. Let's say in Q4, you only had a 10% decline in gross receipts. And so at the end of Q4, you would no longer be eligible. And so you'd be looking at those two periods, Q3 and Q4, wages paid during that period, and that would go toward the credit calculation.
So Matt, did I hear you right that if I qualify in one quarter, I really am qualified for 2 quarters? Is that
That's right? Yep.
Even if the subsequent quarter I didn't meet the test.
Right. So you're always going to, if you're qualifying based on a reduction in gross receipts, you're going to qualify for that quarter, and then at a minimum the subsequent quarter. Even if receipts, increased 100% in that subsequent quarter, the qualifying period ends at the end of that quarter when you're no longer eligible. And so, you're going to get at least 2 quarters of wages that can count toward this retention credit.
So Matt, can I ask what's
Sure.
clarifying question? You mentioned that an employer that began operations in 2020, so they did not have operations in 2019. They are an eligible employer based on what you described, because in this section it doesn't address that. So you're just talking about those who had operations pre-COVID. If they were a new operation that began in 2020, they have that other qualification that they can meet. Is that correct?
Right. And so, yeah, they could have their business impacted, fully or partially suspended due to government order. If they started business, let's say they started in Q4 of 19 and they had, a hard time in Q1 and Q2 of 20, they would actually compare the Q1 and the Q2 results to, the earliest quarter that they have available. So if they started, Q4 of 2019 or Q1 of 2020, you can use that comparison for purposes of meeting the gross receipts test, or you could look to the other test where you had a disruption to your business due to a government order.
Matt, what if I started in Q3 or Q4 of 2020? What would I compare to then?
So your first quarter that you would have to compare would be, let's say Q4. So you'd compare it to Q3 of 2020.
Okay.
And then kind of moving forward, it's always going to be compared to that one. Trying to make sure that that's not conflicting with anything, but it's generally if you, yeah. All right, so here's kind of where that example talks. And so business began in 2019, you're going to compare your reduction to the first quarter that you were in business for subsequent quarters in 2020. Another question that comes up is often, well, what if I acquired a business? You'd have to include the gross receipts when they're part of the organization. Let's say you acquired them in, Q1 of 2020. You're trying to determine if you're eligible in Q2, and you're comparing it to Q2 of 2019 when you didn't have that business. There is a safe harbor that allows you to include gross receipts of the acquired business for purposes of doing the gross receipts reduction. So something to be aware of if there was an acquisition. All right, so the full or partial disruption, business disruption, you'd need to be able to identify a specific government order and how it impacted or partially suspended your operations. And so that order would need to limit either commerce, travel, group meetings, and have jurisdiction over your operations. And so if you're running clinical trials throughout the United States, and for whatever reason, there was, a government order that said you're not allowed to have, certain types of testing or evaluation going on, you had to pause work. That would be an example of, an order that limited your ability to, perform commerce. If you're going out and, you're generating sales from trade shows or conferences, and those were canceled due to COVID because you can't have, large group gatherings, that would be another example of, a partial business disruption. And so you'd have to kind of look at the facts and circumstances. This one's a little less of a, white and black line. It's a little bit more of a gray line because you're looking at how, specific government orders that limited your ability to do work. And so if there was a disruption, if you're a small employer, and it happened at a certain, let's say May of last year, you could qualify time during, and it ended in July 15th. You would be qualified for the retention credit for Q2 and Q3. But if you are a large employer, you'd only be able to look at wages that happened during that actual suspension. And so when it started in May and then when it ended in July. So just something to be aware of, some differences between whether you're a small or a large employer. Another question or, thing to consider with the full or partial business disruption is if you're a hybrid business where you have essential operations that were allowed to remain open and non-essential operations that you had to close. You're going to be looking at those non-essential operations and trying to make a determination whether that portion of the business is more than nominal. And so generally that more than nominal is going to require an analysis of either gross receipts or employee hours and make sure that it's at least 10% or more of the total time that you would have spent on that segment of the business in 2019. So that's something to be aware of. If, an example might be like a hospital and they said, well, you can't do elective surgeries. Well, if those elective surgeries was more than a nominal portion of the business, even though other portions of the hospital remained open, they'd be an eligible employer due to that partial disruption that limited their ability to perform elective surgeries for a period of time. So that might be an example you see.
Matt, just want to do a quick time check. We've got about 10 minutes left, and we do have one question in the Q&A. I want to make sure we have a little bit of time for that. So just wanted to.
I got that one. We can talk about that one later too. But yeah, Matt, let's move through the other ones too.
And so you want to have a valid suspension of operations. And so it needs to be, these would be other examples of suspension of operations that you could use as an example. And so you weren't able to get critical goods or materials. So if you needed API, but it wasn't being manufactured because that plant shut down, you might be an eligible employer. If you're in multiple locations, you only need to be qualified. You only need to find one government order that impacted you, and it applies across the board. And that continue some operations, but not others would be, an example of that hybrid that we talked about a little bit earlier. All right, invalid suspension of operations. If customers are just staying home and it's just causing a reduction in demand, that wouldn't be qualified. If you voluntarily decided to close or just modified customer behavior by requiring mask wearing or social distancing, that wouldn't be a valid suspension of operations. If you can continue operations comparable to operations prior to the closure, so if you can work from home, that wouldn't be an example of a partial disruption because that work is fairly portable. And so there's a couple factors to consider that the IRS puts out in terms of whether or not you experienced a partial disruption. So your ability to telecommute, how long that transition took, how portable is the work, and whether there's really a need for presence in the employee's physical workspace. And so can they do this type of testing out of their home? If not, and they had to close the office, that would be a partial disruption. All right, so quick comparison of eligibility 2020 versus 2021. For 2020, small employers is 100 or less. Your change in gross receipts to become eligible needs to be at least 50%, so greater than or equal to 50%. And then it continues as long as you have at least a 20% decline. So you look at kind of a rolling basis to determine if you continue to be eligible. It's limited to $10,000 a year per employee, $10,000 a year in wages per employee, and the credit is 50% of those wages. For 2021, the small employers is 500 or less full-time employees. To qualify, you only need a 20% or greater decline in gross receipts compared to the same period in 2019. You are able to claim up to $10,000 a quarter in wages per employee, and the credit is equal to 70% of qualified wages. And the last thing I'll point out on that is there is some overlap between the retention credit and the PPP loan. And so if you use PPP loan or wages to apply for forgiveness, the wages that result in forgiveness can't be used for the retention credit. But if you had excess wages and were an eligible employer, those excess wages can be applied toward the retention credit. All right, and with that, Sean, do you want to wrap us up?
Sure. So, in summary, there are several credits that are available, particularly if you're a startup, you don't have any revenue coming in, you're spending money developing. Payroll tax credit is a great answer for you to get some money in your hands. If your business was disrupted because of COVID-19 last year, there is help from the government through the employee retention credit. Then lastly, if you've been in existence for a while, R&D credit's always a great one for you. And then just be mindful if you're developing any kind of therapeutics for orphan drugs that are going to get the orphan drug designation, that one is a very lucrative credit for you. As with all these, documenting how you qualify is key to sustaining these things in the event of an IRS audit, and we are seeing an increase in IRS audit activity. A couple questions came through. One, I think we answered these, but with respect to both of them, with respect to the payroll credit, one, can you claim the payroll tax credit in prior years? No, again, it's the current year. You have to put it on that your return, or you've foregone that chance to claim it for that year. And how many pre-revenue years can you claim the payroll credit? You can claim it up to 5 years. So you're good there. And if you miss a year in between, you're fine. There's nothing that says they have to be 5 sequential years. It's really a matter of meeting the growth. It could be a matter of meeting the gross receipts test at that point. Then what happens? So let's say I put it on the return. How do I actually get the money from a payroll credit? Do they cut me a check? How do they just start reducing my payroll tax obligations? How does that work? Well, in theory, and the IRS has been very clear about this, you can start applying that credit immediately against, once you file your tax return, the next calendar quarter, you can start applying the payroll credit against your against your payroll tax obligations. Now, if you're doing payroll in-house, great, you can do that. If you're using a third party like ADP or Gusto or some of the others, Paylocity, they will each have their own procedures for how they will handle that. Zenefits has stopped. I will tell you that if you're using Zenefits, they have stopped processing payroll tax credits for people. I don't know why, but it's part of their skinny model where they do maybe they're the Spirit Airlines or Frontier Airlines of payroll providers. They very little service, but that we have seen in some instances it taking up to 6 months to get money back, 8 months to get money back because of how the payroll providers handle this. So you need to coordinate with them, let them know this is happening, and find out how they can, how they would facilitate that. Let's see, there was another couple credits come through. Does the election of these credits increase the odds of a federal audit? No, not necessarily. But I will also say it depends. If you're going back and amending a return to claim a credit, any kind of amended return generally heightens your likelihood of audit. Putting it on an originally filed return doesn't normally increase your likelihood of audit. The IRS looks at several factors when they see an R&D credit. They look at the amount of the credit. They look at the amount of the credit in relation to the size of tax that you may owe. They look at your industry. Say, if I'm a advertising company or I'm a retail shop and I'm claiming R&D credits, that would trigger some flags within their system. If I'm a life science company claiming R&D credits, that's not a big trigger, a big red flag there. Let's see. The other question was, can the R&D credit apply in cases where compensation employee is deferred? It can, but it would only come into play when that compensation is actually reported on a W-2, because that's our frame of reference. Those are the numbers we use. So if you defer comp, the services are performed in 1 year, you pay for them in subsequent years, then practically speaking, that's when you would claim the credit. In theory, you could go back and claim the credit in the first year in which it was earned or the services were performed, but that would require generally amending a return, and it gets a little bit nasty. So generally we end up just going with when the comp is reported on the W-2. Let's see, there was another question here. Is small employer, Matt, I'll throw this one over to you. Is small employer defined per the SBA rules that include requiring affiliates in the employer account? How do you treat affiliates or related parties?
So you're going to be looking at parent, sub, or brother, sister organizations and those affiliated or related groups. And so small employer is defined per the SBA rules. So it's 100 or less full-time equivalents during 2019 for 2020 purposes, or 500 or less full-time employees during 2019 for 2021 purposes. But if you've got an owner and he has 2 or 3 companies Because those are considered brother-sister organizations, you would look at the employees across those organizations, combine them to determine your employee count and eligibility for the retention credit.
That also, I'm glad you brought that up, Scott. That also has implications with the payroll credit. If and the ownership threshold we look at is 50%. So if you as a small startup are owned more than 50% by someone else, then that other person's gross receipts come into play when analyzing both the amount, less than 5 million, as well as that 5-year window period. We have a client who we were all excited to get them an R&D credit and even use the payroll credit, that determined that they had a parent that owned 60% of them, and that parent had $1 billion in sales. Well, that shot our ability to claim the payroll credit. They can claim an R&D credit, but it becomes more complicated to do that. So yes, if you have affiliates, those numbers do affect both the employee retention credit as well as the payroll tax credit, and potentially the R&D credit as well.
Yeah. And there was another question from Scott on typical disqualifiers for the payroll credit. And so generally that's going to be, you have more than 5 million in revenue in the current period and that you're trying to claim it, or you had income in you look at your preceding years, and if you've got income in a year preceding the 5th year, hopefully I'm saying that right, you would also be disqualified. And so if you've had revenue in, more than 5 of the last, it's a little hard to explain, but if you've had that revenue in a period before the, looking backwards, and it's more than that 5th year, you'd also be disqualified, because you start a clock from when you first receive revenue, and you can only claim that payroll credit for the 5 tax periods after that revenue is starting to be earned or recognized.
Yeah, Timmy had that. I saw you answer the question to Timmy as well, and I realize we've gone over. These are some great questions. We're happy to continue answering questions as needed, but if you feel like you want to drop that, thank you for listening. What if I want to treat my company? Here's some tax planning. What if I'm going to treat everybody as a consultant versus an employee? What would be the advantage of doing so from a credit standpoint? Well, you would be able to pick up less of the expenses that you pay to that contractor. So if you're paying them $1,000, if they were an employee and that was their box 1 W-2 wage, you would be able to pick up $1,000 of that toward the R&D credit or the payroll tax credit. If they're a consultant, you would only be able to pick up $650 of that. So that's something to keep in mind.
On the retention credit side, if they were an employee, those are potentially qualified expenses. If they're a contractor, they would not count toward the retention credit. So depends on what you're looking at, but.
Yep. So then Scott asked another question. What are typical disqualifiers for the payroll tax credit? The gross receipts is the easy one. You just look at tax returns. You look at ownership too. That could be, if you're part of a broader group or somebody owns more than 6%. The that's the first disqualifier. So are you less than $5 million in the year in which you're seeking to claim the credit? Or do you have gross receipts outside of that 5-year window period? And then the other disqualifier would simply be R&D credit. Are you claiming activities or costs that are not R&D credit eligible? So the standard IRS analysis of R&D credit rules would apply as well. Let's see.
There were 2 more questions there.
There was one.
Scott had a follow-up question on payroll tax credit. Is there any affiliate ownership disqualifier like there is on the ERC, or is it all revenue driven?
Yeah, there is. So again, when you look at computing the revenue for the startup for the payroll credit, you do need to bring in those affiliates. But the cutoff is 50%. So if you as startup company are owned 33% by two different partners, and then someone else, you have a big company that owns the other third, that doesn't matter. It's only when one entity crosses that 50% ownership. And if it's a partnership, then you look at by capital. It's by voter value, or it's by partnership interest, capital or profits interest if it's a partnership. So once you cross that 50% threshold of ownership, then you need to bring in the affiliate gross receipts, both for determining the aggregate, are you less than $5 million, and for that 5-year window period, do you have, if by including that affiliate, does that cause you to have gross receipts outside of that 5-year window period? So hopefully that answers those questions for you. Good, very good questions. If you have any other questions for us, we will distribute the slides, and our contact information is at the front. So feel free to email or call us. We're here in Salt Lake, even though I don't know that my heart is in San Francisco, but my background is. So love to help out any way we can. Kelvin, again, thank you for having us and hosting it. It was a great opportunity to talk with an engaged audience. Appreciate that.
We appreciate very much your expertise and your willingness to share it so freely today. As was mentioned, the slide deck will be made available. We'll also be posting to our website and to our newsletter the actual video recording of this particular webinar. So if you would like to get a copy of the slide deck, just contact us at BioUtah. We'll make sure that gets to you. We appreciate you being on today, and hope you have a great rest of the day. Thank you.